Good morning, everyone. Welcome to the September 2025 meeting of the Teachers Retirement Board. This is the investment meeting.
So we were going to kick today off with a review of the fiscal year returns for the passport funds. This report, I know, was circulated in advance, and the performance through June was also, that report on its own was circulated as well earlier in late July. So I'll cover this off briefly. Let me know if there's any questions, and then we'll switch gears and move into the new fiscal year in terms of reporting on performance. Through June 30th, which was the fiscal year end, the diversified equity funds, the passport funds all produced strong positive returns, generally in line with markets when we look across the different equity markets in which the funds invest in, as well as the fixed income components that are part of the balanced fund. The diversified equity fund ended the fiscal year with assets just shy of $20 billion. The return for that 12-month period was about 14.4%, lagging just behind the global market composite and the hybrid benchmark for the fund. There was some underperformance for the U.S. and non-U.S. equity managers within that fund, which led to some of that underperformance. But it was still a very, very strong year in absolute terms for this fund as well as the others. The balanced fund ended the year with a 9% return and $676 million in assets. The international equity fund was about $300 million in assets. That for the fiscal year had a return of about 14%. You can see below that the returns for the sustainable equity fund also strong. We saw a very strong environment for growth stocks in the U.S., which you see in the benchmark of this fund. This strategy is more diversified across different parts of the market than the benchmark itself, which is leading to some of that dispersion in performance that you see there. And then the index funds roughly in line with their respective benchmarks. The U.S. index up nearly 15%, and the international equity index up right at 18%. So I'll see if there's any questions before we move ahead to July performance.
Any questions for Mike? That's good news. Thank you.
So, on the heels of the strong fiscal year for markets, July got off also to a generally strong start, particularly in the U.S. You can see the diversified equity fund as a whole was up over 1%. The U.S. equity market as a whole was up just over 2%, and then we saw some underperformance for both developed markets and EM, when in aggregate had a return of about negative 0.75%, negative 1% during the month. What we look at here is really taking a step back, looking at what we saw over the course of the summer. We've continued to have market momentum over the course, and we're going to talk a little bit more about what numbers were in August and how the outlook is evolving. But this was really a strong start to the year. The balanced fund had a slight positive return during the quarter. As I noted before, international equity markets were down. You can see the negative 0.75% return for that fund. Sustainable equity fund was up nearly 2% during the month, and then the index funds tracked relatively closely to their benchmarks during the month. So, any questions on that? So the next thing, I started to talk a little bit about August, and this report provides a summary of the benchmarks for the funds across all of the passport funds. You can see U.S. equity markets in particular up over 2% during August. Non-U.S. equity markets up over 3% for developed markets. So developed market benchmark actually up over 4%, and then emerging markets with a more modest positive return to the tune of about 1%. So again, it was another strong month across the board, and should certainly look to bolster continued performance of the funds. We do think as we start seeing differences in sort of the trend to both inflation as well as the labor reports that have been coming out, We do think the tails in terms of potential market outcomes start to get a little bit wider. So we should expect to see a little bit more volatility as we look forward. And I think we'll maybe talk in a little bit more detail about, you know, some of those specific metrics and the evolution of our outlook as we get into the future. So, any questions before we move ahead?
Thank you, Mike. I appreciate it. That brings us up to the public agenda, pension fund and market overview. And we're gonna pass it over to Steve.
Great, thank you, Mr. Chair. Good morning, everyone.
Good morning.
I think Dan Haas is there we go, Dan. One more slide, please, Dan. I'm gonna follow Mike's lead and actually review your performance for the fiscal year ending June 30th, 2025. And it's actually a pretty good story. You can see that your portfolio actually delivered a 10.9% overall return. That's well above your 7% actually assumed rate of return target. Also worth noting, and I don't know if you're competitive with the other funds, but you were top pick, top performer. And the reason for that is I think you have certainly a healthy allocation to public equities, and in particular, a slightly higher allocation to non-US equities, which are really strong performers. So 1 in 3 years, you're slightly above the average, and in 5 to 10 years, you're slightly below the average. And I'd say the outer years, the longer performance, the slight deviation, a slight underperformance relative to New York City combined, was due to a higher allocation to, again, non-US equities, which tended to be a lot underperformer relative to US. So gave a little bit of it then, and you took it back with the recent rally we saw in non-US stocks, with a little bit of a tailwind as well for the US dollar depreciation in the second half of the fiscal year 2025, the first half of calendar year 2025. So all in all, a really good outcome and a lot to be proud of. I should also mention that this also reflects the cost associated with restructuring your private equity book. Remember, the trustees authorized a secondary sale, which was achieved and accomplished in March. That probably took off about 27 basis points of overall return, about a 3% underperformance for about an 8.5% allocation. So, good outcome there. On the next page, please, Dan. Just a look at the breakdown of your returns, the 1-year returns by asset class. So, as I mentioned earlier, your outside allocation relative to some of the other funds at 12.1%. Was the top performer on a relative basis. So developed market world ex-US delivered a 16.5% return. And you can see up top under the 1-year numbers that really strong performance. US equities 15.8, non-US developed market ex-US 16.5, emerging markets 13.9, and global 13.2. So really good performance for public equities. High yield also delivered a great performance with a tightening of credit spreads and a reduction of base rates. And lastly, I'd like to point out infrastructure a little further down. Infrastructure has been a steady and very strong performer consistently over a long time horizon. And here you can see a 12% return. And I think Patrick Blair, George, and others have done just a phenomenal job in terms of positioning the portfolio for outperformance there. So again, a really good outcome. Any questions on that? You can see, I'd say the last point I would make is a couple of observations, a little bit of challenge in terms of the returns for private equity. And I mentioned about a 27 basis point or 300 basis point reduction into the overall returns associated with the restructuring of that portfolio, which is meaningful and will help power performance to be much stronger going forward. Real estate has continued to struggle with a backup in interest rates, and any declines we have in short and long-term interest rates will probably support real estate prices going forward. And lastly, alternative credit, a steady performer. We expect to see 9 to 11% returns. 9.5% is really quite good. Maybe on the next slide, just a quick economic update in terms of where we are from a markets and economic perspective. I'd say the summary is growth is slowing in the US. Inflation is rising. We actually had new CPI numbers out this morning for August, which reflected an increase in CPI from 2.7% to 2.9%. And core came in at 3.1%. So inflation is well above the Fed's 2% target. We had a first quarter GDP was actually revised upward from a contraction in the first quarter 0.5 to 2.1 early estimate, and actually came in at 3.3%. A lot of that had to do with positioning around tariffs and people trying to get ahead of that in terms of buying and just buying things that they expected to see more expensive down the road. On the upper right-hand side of this chart, you can see U.S. jobs market is actually slowing down a little bit. And it's at 4.3% unemployment in August. That was released last Friday. And non-farm payroll growth actually came in a disappointing 22,000 jobs created relative to consensus of 75,000. So employment's slowing, inflation's moving higher. The Fed did talk about, or I should say, Fed Chair Powell talked about it at Jackson Hole, Wyoming in August, that he thinks that the inflationary pressures are transitory. We hope he's right. And the expectation is, based on this information, a slowing in employment and moving a higher inflation, but we think it's temporary. I should say the Fed thinks it's temporary. We're expecting to see a Fed rate cut next week on Wednesday, the 17th, when they finish up their two-day meeting. So the last point in this slide, on the lower right-hand side, you can see there's a lot of green under world currency rates. The green actually represents the depreciation of the US dollar relative to other currencies. And that's the tailwind I talked about. And if you look at, say, euro up top, it's actually, in the last 6 months, it's appreciated relative to the dollar by 8.4%. And if you invest in developed market ex-US, many of those holdings are euro denominated, it creates that tailwind. And I'll give you an example of that a little later today. On the next slide, just a quick look at rates. I mentioned earlier up top, Fed funds rates right now are in a range of 4.25% to 4.5%. They've been there since the end of December. Remember, we had the Fed reduce rates by 100 basis points starting in September of 2024 by 50 basis points, with subsequent cuts in October and December. And we're expecting them again to initiate rate cuts next week with a 25 basis point cut. ECB came out today. They're on hold. They're at 2% level. It looks like they're planting the flag of success, and they have given no further guidance in terms of additional rate cuts that are expected. The lower side, you can see U.S. Treasury yield curve in red is most recent in September. It's positively sloped and becoming even more so if and when the Fed does cut rates. And the market expectation right now is pricing in 3 full 25 basis point rate cuts by year end. You'll see that really normalize as short rates move down. And again, that upward sloping yield curve as maturities increase. On the upper right-hand side, you can see corporate spreads. Credit spreads right now in investment grade, they typically average over a longer time period about 110 basis points. They're only at 80 now, which means that those holdings have actually increased in price and yields have come down a little bit. And it indicates a level of confidence of economic growth and a low level of current defaults. Similarly, with high yield right below that at 280 basis points, typical spreads are between 330 and 350. So again, tight credit spreads indicates sentiment, which I think is positive. Also, investor flows into corporate assets, corporate bond assets, given base rates are higher. They're floating rate obligations. We also have to see SOFR. 3-month SOFR still trading above 4%. And lastly, below that, you can see current 2-year yields have moved down to 3.5%. U.S. Treasury 10-year yields at 4.06%, which is quite low. 30-year mortgages have come down under the 7% threshold at 6.61. And gold, unfortunately, this is a misprint. Actually, gold is $3,629 as of this morning, troy ounce. So indicating a flight to quality and potentially of an inflation hedge there as well on the part of investors. On the next slide, just a real quick, a lot of green on the left-hand side. Those are stock and bond, stock, U.S. and non-U.S. stock valuations. I mentioned I would come back in a moment about the tailwind associated with the euro's appreciation relative to the dollar. And if you look at the 24th line, it's got the DAX, that's the German stock market index. And you can see that the performance in local currency terms is 18.51%. But when you convert those returns back to US dollars, and we are a US dollar investor, it's a fully 30% return. So really quite healthy and quite strong. On the right-hand side, I look on the far right-hand side of that chart where the change is. And up top, we have US Treasury 10-year bonds. You can see that the the yields have actually come in 35 basis points. Lower yields, higher prices. Unfortunately, that's not the case for the rest of the world. All those plus signs on the right-hand side indicate that yields have moved up and bond prices have moved lower. And there's been a lot more volatility in bonds this year as a general matter, particularly in some of the economies such as France, Italy, and Japan more recently, in terms of backup yields. On the next slide, just a quick look at market volatility. Volatility has been pretty subdued relative to where it was on average. You can see a little bit of a spike in green in bond volatility on the far right-hand side. That's good volatility, meaning that the volatility has been increasing in prices and declining yields more recently. But again, pretty subdued. On the next slide, just to look at a couple of headlines. On the upper left-hand side, a reference to all the green we saw on the screens, and the stocks have rallied in hopes of rate cuts. And that is ongoing. Again, the market, as I said, is expecting 3 full 25 basis point rate cuts this year. Below that, we had BLS statistics that were revised through March of this year, indicating that the growth in employment was actually 911,000 jobs fewer than initially forecast. I don't know how relevant that is for the Fed in terms of their forward-looking assessment on employment, but it is worth noting that the employment picture isn't quite as strong as we may have thought. And lastly, on the lower left-hand side, Treasuries end a 4-day run as interest turned towards inflation. So even though inflation came in as expected but higher today, bonds rallied because, again, it kind of, when they came in as expected, it fortifies the outlook for those Fed rate cuts. If inflation keeps going much higher and much faster than the market expects, it may tie the Fed's hands. They can't cut rates in a rising inflationary environment. A couple other just quick slides. The next slide, Dan, is a look at dissenting votes on the Fed. You can see back in the Volcker era in the 1980s, 1989 in particular, there are a number of members of the Fed voting committees that actually took an alternative view relative to the consensus. We had a long period of time following the global financial crisis through to 2023 where there was broad consensus and no dissents. The only reason I mentioned this is you have seen a little bit of an increase in dissents more recently. The expectation is those will increase as the composition of the Federal Reserve Voting Committee actually changes. We've heard a lot about that. On the next slide, a quick look at employment by payrolls and the impact on tariff. You can see that those jobs that are related in green on the bottom are actually showing a contraction. Those jobs tend to be more impacted by tariffs. But as a general matter, the employment picture is slowing for both service, tariff-related and non-tariff-related jobs. On the next slide, just a quick look at inflation for goods relative to services. Services are in blue, and on the far right-hand side, you can see that goods prices are being impacted by the potential increase of tariffs. And we can see that there's a little inflationary move upward in goods, while we've seen a decline in service related inflation. And lastly, the next slide, just look at, and I love this, this is the twin peaks of inflation we saw in the late 1970s and 1980s. And a lot of people love to run the parallel. And the question is, are we going to see another spike in inflation through the cycle we're in now? So in green, you can actually see the core CPI where it is today relative to where it was from 1974 to 1982. And as I think I've said in the past, I remember, well, this is when a tuna helper first entered the Meyer household instead of steak, but we all survived. And with that, I'll open up for questions.
Thank you, Steve. Appreciate it. Well done. Questions for Steve? So I guess we do the risk update.
Mr. Chair, there's not going to be a risk update today. We wanted to save time because we have a number of deals, and Ed Berman's going to go through more of a deeper dive into what we're doing in the equity front and some of the analytics we built.
Okay, good. Thank you for letting us know that. I think that covers everything in the public agenda for today's meeting. So I'll entertain a motion to go into executive session.
So moved.
It's been moved and it's been seconded. Thank you. Any questions? Is there an approval? All those in favor of going into executive session, please say aye. Aye. Those opposed say nay. Abstentions? We're now in executive session. We are now in public session. Okay, no. Wow. Priscilla, we will have a readout from Priscilla Bailey at this time.
Thank you, Mr. Chair. In the executive session of the Passport Fund, there was a manager update, there was a transition update, and the board received an overview from its consultant and manager presentation on an investment recommendation. In the executive session of the pension fund, there was an update on preliminary performance. There was an update on public equities, which was followed by a board authorization for a search in public equity. Next on the agenda, there was a private equity presentation.
So we lost you.
We lost you.
Where did you lose me?
Private equity.
Okay. There was a private equity presentation. Consensus was reached. There were two infrastructure fund presentations. Consensus was reached on both. There were two real estate presentations.
Lost again.
We lost you, Priscilla.
Again. We lost you.
Sorry. With
Two
how
real
about,
estate presentations. No, we lost you again.
yes, I don't know what's going on. There were two real estate presentations. Consensus was reached on both. Is that good?
Yes.
Yeah. Details to be made public pending further action and at the appropriate time. Thank you.
Thank you, Priscilla. Thank you, everybody. And as always, I thank Will, our recorder, and Rich, our TRS tech. And before we adjourn, I just wanted to say something. 24 years ago, right in this neighborhood, that we lost so many people in 9/11, and just like us to perhaps stand and have a moment of silence and a reflection for the first responders and our people we lost. Thank you. And with that, is there a motion to adjourn? So moved.
Second.
And consensus. All those in favor of adjourning, please say aye. Aye. Those opposed, say nay. We are adjourned. Thank you, everybody.